We're not approaching stage 5. We're already inside it. And that's not a prediction, that's a pattern so old, so consistent, so brutally mathematical, that every empire, every financial cycle, every generation walks straight into it thinking, this time will be different. It never is. If history rhymes, and it always does, we have 18 months left on the clock. 18 months from the moment stage 5 begins, to the moment the system cracks wide open. That's exactly how long it took in 1929. From the moment insider selling quietly spiked, to the moment the Dow Jones vaporized 89% of its value. The countdown lasted 18 months, not 17, not 20, 18. And here's the part that sends a chill through anyone who's studied financial history. You can map every single month, because bubbles may have different faces, different technologies, different headlines, but the human psychology underneath doesn't change. Fear, greed, delusion, capitulation, the four horsemen of every market collapse. Today, November 2025, we are standing exactly where America stood in September 1929, and most people don't even feel the ground shaking yet, but the shockwave is already underway. The ghost of 1929. Let's rewind the tape. September 1929. The Dow hits its all-time high, 381.17, a number it wouldn't see again for 25 years. The newspapers were euphoric. Economists were proclaiming a permanently high plateau. Bankers were hosting dinner parties, celebrating the unstoppable American miracle. It felt like the future had no ceiling. Sound familiar? Behind the scenes, the people who understood the math, really understood it, were quietly exiting through the back door. Joseph Kennedy, who made his fortune on Wall Street, liquidated most of his holdings. Bernard Baruch, the legendary speculator, moved to cash and government bonds. And British banks, who'd seen bubbles from the South Sea frenzy of 1720 to the railway mania of the 1840s, were dumping US stocks like they were radioactive. Why? Because margin debt had hit 8% of GDP. At that level, a 10% decline isn't a pullback, it's a detonation. When everyone is leveraged to the eyeballs on 10% down payments, and stocks fall 10%, their entire equity gets wiped out. And when equity is wiped out, brokers don't ask. They liquidate automatically. Every sale triggers more sales. Every margin call creates more margin calls. It becomes a self-feeding machine, a mechanical avalanche. That is stage 5, not the crash, the beginning of the end. When Wall Street stopped listening to reality. Now here's the sinister part most history books skip. By September 1929, the real economy had already turned. Corporate earnings peaked in Q2. Industrial production dipped. Commodity prices weakened. Factory orders fell. The body was dying, but Wall Street was still dancing. This disconnect, prices rising while fundamentals rot, is the signature of stage 5. The moment markets stop trading on reality and start trading on momentum and belief, exactly like today. In November 2025, the Dow and S&P are at record highs. Warren Buffett is sitting on $325 billion in cash, the largest war chest in Berkshire ES history. Corporate insiders are selling more stock than at any time since 2007. Margin debt is brushing up against the critical 8% of GDP threshold. Earnings growth is stalling. Guidance is being cut. Commercial real estate is cracking. Regional banks are wobbling. And yet, the market keeps climbing. That's not optimism. That's denial with a Bloomberg terminal. The official start of the countdown history is mercilessly clear. Stage 5 begins quietly. Insiders sell first. Smart money exits early. Retail investors keep buying. Stage 6 is the crack. One day, one event, one trigger, the spark that lights the fuse. Stage 7 is the grind, a slow psychological torture chamber, months of lower lows, hope crushed again and again. Stage 8 is collapse, forced liquidation, mass unemployment, institutional failures, panic, capitulation. The transfer of wealth from the unprepared to the prepared. Right now, in November 2025, we are at the same point. 1929 was in early September, the moment right before the crack. The moment when the chart is at its highest, but the system is at its weakest. The pattern says the first real break hits in 30-60 days, November or December 2025, And once it starts, nothing, not the Fed, not Congress, not hope, can stop an 18-month unwind. Rewind to the first rumble. October 1929. October didn't crash all at once. It started with nervous, heavy-volume trading. Professionals call it distribution, smart money selling to dumb money. Then came October 18th, a sharp drop, recovered by the close, just a tremor. October 21st, more selling. October 22nd, heavy volume again. October 23rd. Panic whispers, rumors, banks calling emergency meetings. At JP Morgan's offices, the titans of finance tried to hold back the tide, a last-ditch, support the market pool. Newspapers celebrated them as heroes. But over the weekend, margin call letters hit mailboxes across America like a rain of white envelopes carrying dynamite. Then came October 28th, 13%, and October 29th, 12%, 16 million shares. The most notorious two-day collapse in history. But here's what almost nobody understands. That wasn't the crash, that was the crack. Month 1 of 18, the real destruction came later, quietly, systematically, mathematically, just like it will this time. The hidden timeline begins again. The public sees chaos, but the smart money sees sequencing. Crack bounce, grind collapse, capitulation transfer bottom. It's the same skeletal structure every time, from 1720s South Sea bubble to 1929 to 2000 to 2008. And now, 2025, 2027. We are repeating the most dangerous pattern in modern financial history with eerie precision. And the clock has just started. On September 3rd, 1929, the Dow closed at 381.17. No one standing on Wall Street that afternoon knew they were staring at a number the market would not see again for a quarter of a century. To the average investor, nothing looked wrong. The front pages were bullish. Investment newsletters shouted, "New era." The most famous economist in America, Irving Fisher, was lecturing about a permanently high plateau. But inside the system, the fault lines were already glowing. The anatomy of a leveraged dream. Behind closed doors, people who understood leverage weren't celebrating, they were evacuating. Joseph Kennedy knew what 10% margin really meant. If you borrow 90 cents for every 10 cents you put down, a 10% drop doesn't hurt a little, it wipes you out. When stock prices fall 10%, your equity goes to zero. Your broker doesn't ask if you'd like to sell. Your positions are liquidated, whether you agree or not. That's why Kennedy cashed out. He didn't need a crystal ball. He just needed arithmetic. Bernard Baruch did the same. He'd lived through earlier panics, 1907, 1914. He recognized the manic conversations, the sneering dismissal of any warnings, the mystical belief that this time is different. Across the Atlantic, British banks had seen this movie centuries earlier. South Sea bubble, railway mania. They knew that when valuations detach completely from earnings, when barbers, bartenders, and shoeshine boys all talk stocks, you're not in the middle of a boom. You're in the final act. So what did they do? They sold American equities to the very people convinced they were about to get rich. And it wasn't just famous speculators or foreign banks. Corporate insiders, the executives and directors who knew their companies better than any analyst, were unloading 50%, 60%, even 70% of their holdings. Not small, symbolic sales, not diversification, systematic liquidation. Why? Because they could read the internal numbers. Earnings had peaked in Q2 1929. New orders were sliding. Industrial output was flattening, then declining. Commodity prices were weakening, signaling demand was softening. Wall Street was still cheering. But the real economy had already passed its turning point. That disconnection, rising prices, weakening fundamentals, is the birthmark of Stage 5, exactly where we are now. The Mirror, November 2025. Today, in November 2025, the reflection is haunting. Index is at or near all-time highs. Warren Buffett holding $325 billion in cash, the largest pile in Berkshire's history. Insider selling outpacing insider buying by enormous ratios. Margin debt pressing against that 8% of GDP danger zone. Corporate earnings flattening, guidance being trimmed. Commercial real estate quietly blowing up on bank balance sheets. And yet, The dominant narrative is the same as 1929. The economy is strong. Unemployment is low. The Fed has our back. AI and tech change everything. In 1929, they called it a permanently high plateau. In 2025, they call it the AI supercycle. Different story, same psychology. When reality and prices move in opposite directions, the clock does not start ticking. It's already been ticking. You just finally hear it. The pattern says, from this stage 5 moment, you have about 18 months until the 1931 equivalent moment, where most of the damage is already done. For us, that points roughly to March 2027. October 1929, the crack, not the collapse. From the official peak in early September, it took weeks for the first visible cracks to appear. October opened with choppy trading, up a bit one day, down a bit the next. But underlying it all, huge volume. Professional traders knew what that meant. This wasn't enthusiastic buying, it was distribution. Big players unloading their shares into the eager hands of the public. Then came the sequence. Friday, October 18th, a sharp drop. The market recovers by the close, but something feels different. Monday, October 21st, more selling pressure. Tuesday, October 22nd, heavy volume, widening spreads. Wednesday, October 23rd, panic whispers. Major banks convene at JP Morgan's office to orchestrate a rescue pool. They marched to the trading floor, bought blue-chip stocks in size, and the market bounced. Newspapers celebrated. Bankers restore confidence. Panic averted. But while front pages cheered, back rooms went cold. That weekend, margin call letters began landing in mailboxes across America. Tens of thousands of investors opened envelopes and discovered they no longer had investments. They had margin debts. To keep their positions, they had to wire in more cash. Most didn't have it. So Monday, October 28th, the avalanche began. The Dow fell about 13%. Tuesday, October 29th, now known as Black Tuesday, it plunged another 12%. 16 million shares traded, a record. In 2 days, the market lost roughly a quarter of its value. But here's the key, that wasn't the full crash. That was month 1 of the 18-month collapse. The crack, not the bottom. The moment forced selling became structural. November, December 1929, false hope. After that brutal 1-2 punch, something almost cruel happened. The market stabilized. From early November through December 1929, prices bounced around but didn't collapse further. Roughly 30% below the peak, the Dow found a ledge and hung there. The message in the media? The panic is over. The excesses have been purged. Now stocks are attractively valued. Investment advisors told clients this was their chance. The ultimate buy the dip, and many believed them. They saw 30% off as a clearance sale, not realizing they were buying at the beginning of the descent, not the end. History has a dark sense of humor. The people who pounced on that first bargain rally watched their portfolios get cut in half again and again. By the time the real bottom arrived, they had lost 80–90%. That brief stabilization, that dead cat bounce, wasn't a gift. It was a trap. The 2025-2026 overlay, how the pattern repeats. Now overlay that onto November-December 2025. Based on this pattern, sometime in the next 30 to 60 days we should expect a sharp, single-day decline, maybe 3 to 5%. Not unheard of, but unsettling. A reflex rally. Institutions step in, algorithms buy, pundits call it an overreaction. A larger drop, 5–8%, volatility spikes. Talking heads start using the word correction. The real crack, a 10–15% plunge over a day or two. The modern echo of Black Thursday from Black Tuesday. And just like 1929, that violent move won't be the end. It will be month 1. The headlines will blame a specific trigger, a major bank failure, a blue-chip company missing earnings catastrophically, a geopolitical flare-up, a shock in the bond market. The trigger doesn't matter. An over-leveraged system doesn't need one precise match. It's sitting in a room full of gasoline fumes. The important part is, once forced selling starts, the process becomes mechanical. And after that first crack moment in late 2025, the pattern says we'll see exactly what 1929 saw. A stabilization phase, a fake sense of safety. December 2025, January 2026, the dead cat returns. Just as late 1929 offered a deceptive calm, December 2025 through January 2026 will likely feel less terrifying. After the initial shock, the market may rally 10–15% off the lows. Financial media will declare the worst is behind us. Analysts will talk about once-in-a-decade buying opportunities. CEOs will go on TV and say they're confident. Strategists will publish reports titled something like, "Why This is a Healthy Reset." Retail investors will hear one message repeated endlessly: buy the dip. This is your chance. Underneath that surface optimism, the silent damage will already be spreading. Banks nursing losses on leveraged loans and margin accounts, quiet tightening of credit standards, businesses seeing orders slow, early rounds of layoffs beginning, delinquencies on mortgages, auto loans and credit cards ticking higher. Just like 1929, most people won't connect the dots yet. They'll see a market that bounced, they'll hear soothing language, they'll cling to the idea that this was a brief scare, not the front edge of a historic unwind. The pattern calls this phase month 2 and 3, the false hope window, the most dangerous place to put new money in, and the hardest place to stand aside. Because the human mind hates unfinished stories. It wants the crisis to be over long before the math says it is. In 1929, the people who bought that first bounce paid one of the highest tuitions in financial history. In 2025–2026, the pattern suggests the same trap will be laid again. Just with better graphics, faster apps, and push notifications. The names change, the platforms change, the leverage and the psychology do not. And after false hope runs its course, the real grind begins. January 1930 arrived like a sigh of relief. The chaos of October was months behind. Markets were still bruised, still far from their highs, but they were stable. And for a population desperate for normalcy, stable felt like salvation. The Dow was down roughly 35% from the peak. Painful, sure, but survivable. People told themselves it was just a bad year, not a historic turning point. But that's the trap of month 4. The human mind wants the nightmare to end long before the math says it will. And markets, like history, don't bend to hope. Because January 1930 wasn't a recovery. It was the beginning of the most relentless psychological torture test in financial history. A 6-month grind where the market didn't crash. It deteriorated. Not fast enough to provoke action. Not slow enough to ignore. Just enough to wear people down. The slow bleed begins. Here's the monthly sequence: February 1930, 5%, March 1930, 3%, April 1930, plus 2% bounce, false optimism, May 1930, 7%, June 1930, 10%, no fireworks, no Black Tuesday moments, just an exhausting, grinding descent. Every rally fizzled, every glimmer of hope was crushed. Every good news headline was steamrolled by reality days later, and reality was deteriorating fast. The economic data started flashing red. Unemployment, which was just 3% in 1929, surged to 8% by mid-1930. Industrial production crashed 20%. Commodity prices sank. Factories slowed or stopped. Wages were cut across industries. Farmers saw the value of their crops fall below the cost of growing them, but the stock market wasn't collapsing. It was simply sinking, like a ship with too many leaks. And that's far more dangerous. A sudden crash shocks people into action. A slow decline lulls them into denial. By June 1930, the Dow sat around 220, down 42% from its peak. People weren't panicking yet. They were rationalizing. It has to turn soon. We've come down so far already. Valuations are finally reasonable. The worst is behind us. They said the same words in 2001 and 2008 and 2022. And now, in 2025. Hope doesn't die quickly. It gets squeezed out slowly. The psychology of the grind. This phase breaks people not through fear, but through exhaustion. Investors watched, positions down 30%, then 40%, then 50%. Every time they considered selling, they thought, after it drops this much, now would be the worst time to sell, so they held. They held because admitting defeat is harder than losing money. They held because they wanted the story to end differently. They held because they believed recovery was inevitable. But markets don't reward belief. Markets reward positioning. And by mid-1930, positioning was catastrophic. The bank failure domino begins. Then something started happening in the background. Quietly at first, then loudly, banks began to fail. Not the big Wall Street institutions, not yet. It was the local banks, the ones that held the deposits of farmers, small businesses, and everyday families. In the first 6 months of 1930, more than 600 banks collapsed. When a bank failed in 1930, depositors lost everything. Savings evaporated overnight. Businesses lost their payroll accounts. Entire towns spiraled into panic. With no FDIC, failure meant total loss. Fear spread like wildfire. People rushed to withdraw their deposits from all banks, good or bad. And when everyone wants cash at the same time, even healthy banks die. Withdrawals forced more failures. Failures created more fear, fear caused more withdrawals, and the cycle fed on itself. This is the first doom loop of any major crash. Bank failures, business failures, job losses, loan defaults, more bank failures. Once it starts, it's brutally hard to stop. This doom loop killed the market far more effectively than Black Tuesday ever did. The 2026 mirror, how it will likely unfold. Based on the historical pattern, January to June 2026, months 4 to 9 of the modern 18-month cycle will likely look disturbingly similar. Here's the projected sequence if the pattern holds. The market grind. Every month brings a new low. Every rally fails to make new highs. The psychological fatigue grows. Unemployment surges 4%, 6%, 8%, 10%. Major corporations announce layoffs. Thousands, then tens of thousands. Hiring freezes become normal. Earnings collapse. Companies miss expectations quarter after quarter. Profit margins shrink. Revenue growth slows or reverses. Guidance is cut across industries. The banking cracks. Regional banks, especially those overloaded on commercial real estate, begin failing. Loan losses surface. Banks reduce lending dramatically. Credit tightens for businesses and consumers. You'll see names in the news, small banks in small towns, banks you've never heard of. But each failure shakes the confidence of millions. Just like 1930, depositors move money from small banks to big banks, from big banks to money markets, from money markets to treasuries, from treasuries to cash. When distrust begins, it does not reverse easily. The Fed tries and fails, and this part is important. The Federal Reserve will not be able to stop the decline. They will try cutting rates, restarting QE, injecting liquidity, emergency lending programs, backstopping banks, buying bonds, temporary facilities, coordinated actions with Treasury. But none of it will reverse the underlying problem. Too much debt, not enough cash flow. When households, corporations, and governments are already drowning in leverage, you can't stimulate them into borrowing more. Economists call this the pushing on a string problem. History calls it the moment when central banks lose their magic. We saw it in Japan, 1990s, Greece, 2010, China's property crisis, 2021 onward, the US in 1930. Liquidity doesn't fix insolvency. The halfway point of the decline, by June 2026, the pattern suggests the Dow and S&P could be down 50-60% from peak levels. Trillions in household wealth evaporated. Retirement accounts halved. Consumer confidence collapsing. Corporate bankruptcies rising. And yet, most retail investors will still be holding, still hoping, still believing it must recover soon. They will be emotionally drained, but unable to act. Because they've already lost so much that selling now feels like surrender. What they don't know is this. They haven't reached the breaking point yet. That comes next. The phase where hope doesn't just fade, it breaks. The phase where people stop saying, it will recover, and start saying, I can't take this anymore. The phase called capitulation. and in the 18-month pattern, it begins right after month 9. By July 1930, something in the psychological atmosphere shifted. For 9 months, the market bled slowly. People were tired, anxious, frustrated, but not broken. They still held on to their positions. They still believed recovery was coming. They still told themselves, it can't go much lower, but belief is a luxury of the early stages of a downturn. By month 10, belief begins to rot, and then the descent accelerates. The snap, when the slow bleed turns into a freefall, July 1930, 15% in one brutal month. August 1930, another 12%. September 1930, a staggering 18%. This wasn't a correction anymore. It wasn't a grind. It wasn't volatility. It was a collapse. And it happened for one overwhelming reason: forced liquidation. Every type of investor, from individuals to institutions, was being crushed under the weight of leverage, losses, and fear. Individuals who'd been down 40–50% finally gave up. Investment trusts facing redemptions had to sell. Banks needing liquidity dumped their stock holdings. Insurance companies, hammered by claim payouts, sold to raise cash. Corporations began dumping assets to survive. Everyone became a seller. No one became a buyer. Markets don't fall because there are sellers. Markets fall because there are no bids. Prices didn't decline, they airdropped. Bid-ask spreads blew out so far that selling a stock at the last price became impossible. You wanted to sell at $20. The bid was at $16. Tomorrow it might be $12. You accepted the hit. You had no choice. That's capitulation. The second bank, failure wave. The one that breaks society. By late 1930, bank failures multiplied. Over 1,000 banks failed in a single year. Communities lost their life savings. Businesses lost their payroll deposits. Local economies shut down overnight. People began withdrawing cash everywhere, not because they needed the money, but because they no longer trusted the system. When trust evaporates, the entire financial infrastructure collapses. Banks don't keep your deposits in vaults, they lend them out. When depositors panic, even healthy banks suffocate. By December 1930, fear had become the country's new currency. The holiday season, normally bustling with joy, felt like a funeral. Stores were empty, cities dim, streets quiet. People were hanging on to every dollar because they knew every dollar might soon be their last. The economy begins to break, socially, not just financially. By January 1931, America wasn't in a recession, it was in freefall. Unemployment, 15% industrial production, 30% steel mills running at 30% capacity. Auto plants, closed construction, stopped farms, bankrupt bank accounts, vanished. Bread lines stretched around city blocks. Churches overflowed with families needing food, parks filled with makeshift shanty towns, the infamous Hoovervilles. The middle class didn't just lose money, they lost stability, dignity, security, and the stock market reflected that despair. By February 1931, the Dow hit 160, down 58% from its peak. By March 1931, the 18-month mark, the damage was largely done. The market had destroyed most retail wealth. The hope that kept people holding for a year had finally broken. This is the inevitable emotional arc of every collapse. Denial, anxiety, hope, doubt, fear, panic, capitulation, resignation. By month 18, the emotional cycle was complete. But the financial cycle wasn't. The bottom didn't come until 1932, at 89% down. The wealth transfer, the part most people never see. By early 1931, the middle class had been drained dry. Their savings were gone, their portfolios wrecked, their jobs lost, their homes at risk. They had nothing left to sell, but others had cash, and cash in a depression is a weapon. People like Joseph Kennedy, Bernard Baruch, the Rockefellers, the Mellons. The old money families who had exited before Stage 5 began. They stepped in and bought stocks at 60% to 90% off land for pennies, distressed businesses, bonds yielding double digits, entire companies for the price of a townhouse, and they multiplied their wealth over the next decade. Generational fortunes weren't built in good times, they were built in the depths of collapse, by people who had liquidity when everyone else had fear. That is the hidden pattern economists rarely talk about. Crashes don't destroy wealth. They transfer it. From leveraged hands to liquid hands. From the emotional to the rational. From the unprepared to the prepared. The 2026-2027 mirror the modern capitulation. If the 18-month pattern repeats, and it has repeated with eerie consistency across multiple collapses, July 2026 to March 2027 is the modern equivalent of this capitulation phase. What the pattern forecasts. 1. Market collapse accelerates by summer 2026, down 50-60% by fall 2026, down 60-70% by March 2027. Possibly deeper. The S&P could lose 2/3. Individual stocks, 80-90%. Some will go to zero. 2. Unemployment surges, 12%, 14%, 15%. Corporations slash jobs to survive. 3. Corporate graveyard emerges. Brands we think are too iconic to die will fail. Department stores, already dying. Commercial real estate giants, very vulnerable. Large retailers, crushed by debt. Tech darlings, the ones with no earnings will vaporize. Expect bankruptcies, expect emergency acquisitions, expect mergers at pennies. 4. Banks fail in clusters. The FDIC insurance fund is 130B. Insured deposits, over $10 trillion. If 2 to 3% of US banks fail, the fund runs dry. Some depositors may face losses even with insurance. 5. Social and political turmoil. Crashes don't just break markets, they break societies. Protests, strikes, political extremism, demands for radical change. Breakdown of trust, new populist leaders, rising old institutions, losing legitimacy. The stock market isn't a financial instrument anymore. It becomes a psychological scoreboard of societal stress. 6. The wealth transfer repeats. The middle class sells out of fear. Institutions buy out of calculation. Prepared investors accumulate assets at historic discounts. Just like 1931-1932, just like 2009, just like every reset in history. And that leads us to the final phase. When the pattern becomes explicit, when the blueprint reveals itself, and when the opportunity becomes visible to anyone who understands where we are in the sequence. By March 1931, the 18-month pattern reached its critical point. The Dow had fallen from 381 to 160, a 58% collapse. Not the bottom, but the moment when most of the wealth destruction had already happened. Not on one day, not on Black Tuesday, but over 18 systematic months of forced selling, denial, and slow psychological erosion. By this stage, almost every retail investor had made the same fatal mistake. They held during the first drop, bought the first dip, held through the grind, sold at the worst moment, the moment of despair. Hope is cheap at the top. Hope is lethal at the bottom. Because in the darkest months of the collapse, when the streets were lined with breadlines and Hoovervilles, when unemployment was above 15%, when newspapers declared capitalism dead, that was the moment the prepared stepped forward. Joseph Kennedy, Bernard Baruch, old money dynasties, they bought aggressively. They bought the country at clearance prices. And the next decade turned their courage into generational wealth. That's the silent rule of every collapse. Crashes don't erase wealth. They transfer it. From the emotional to the rational. From the unprepared to the prepared. From the leveraged to the liquid. And if the pattern is repeating, and every signal says it is, the next transfer will be the greatest of our lifetimes. The 6 signals. Why November 2025, September 1929. The original video listed them, but let's give each one the historical weight it deserves. 1. Insider selling at record highs. Executives are selling 20-to-1 relative to buys. That is not tax planning, not diversification, that is evacuation. This same ratio happened in 1929, 2000, 2007. Every time, it signaled stage 5. Minute, Warren Buffett. Sitting on $325 billion Buffett is not a trader. He's a historian with a calculator. He only hoards cash when the market is grotesquely overpriced. He sold down Apple by 60%, Bank of America. Several industrials. Nearly all Japanese trading houses over 100 billion in stocks in 2023-2024, and he bought nothing significant. Why? He's waiting for the reset. Buffett did this in 2008-2009. He made billions. He's setting up the same move. 3. Margin debt at the red line. History is precise on this. When margin debt reaches 8% of GDP, a crash follows within months. We're touching that number now. This isn't fear, it's math. 4. Valuations detached from reality. Schiller PE at 35, more than double the historical average. Only exceeded in 1929 dot-com bubble. Every time valuations exceed 30, a reversion follows. Reversion isn't gentle, it's violent. 5. Economic data rolling over, GDP slowing. Manufacturing PMI below 50, contraction. Corporate earnings peaking, commercial real estate imploding, regional banks starting to fail. This is not a soft landing, it's the quiet beginning of a hard reset. 6. Sentiment at euphoric extremes. When people believe the Fed won't allow a crash, AI changes the laws of economics. Stocks always go up. Valuations don't matter anymore. You're not in a bull market anymore. You're in stage 5 delusion. Every great crash is born in euphoria. We saw it in 1929, Japan, 1989, dot-com, 2000, housing, 2007, crypto, 2021, and now, 2025. The 4 phases you must follow or be wiped out. This is the core of the video, and the part viewers will replay multiple times. The 18-month cycle is not random. It's structured, predictable, and exploitable. Here's the framework. Phase 1, November to December 2025. The last window to de-risk. This is the last chance to reduce exposure, sell speculative stocks, move to cash or T-bills, buy puts as insurance. If you're 80-90% in stocks, you bring that down to 40-50%. You are not missing gains, you are buying survival. History rewards the cautious before a collapse, never during. Phase 2, December 2025 to January 2026, the crack and the dead cat. You'll see a sharp 10-15% fall. A reflex rally, experts begging you to buy the dip. Analysts declaring the bottom is in E. Optimistic headlines everywhere, but this is month 1 to 3. Buying here is catastrophic. In 1929, buying that first dip was the costliest mistake of the entire depression. In 2025-2026, it will be the same. Use the bounce to finish de-risking. Phase 3, February to June 2026, the grind down. This is the psychological torture chamber. Market hits new lows, monthly, rallies fail, earnings collapse, layoffs surge. Banks start failing credit contracts. Retail investors lose hope. This is the hardest phase. Do nothing, just wait, hold cash, be patient. Because Phase 4 will give you the opportunity of a decade. Phase 4, July 2026 to March 2027, the capitulation and the wealth transfer. This is where courage pays, not at the top, at the bottom. This is the moment to begin scaling in, buy strong companies at 50-70% off. Accumulate assets, people are forced to liquidate, deploy cash strategically. You do not buy all at once, you buy in waves, start at 50%, add more at 60%, add again at 70%. This is exactly what Kennedy did, what Rockefeller did, what Buffett did in 2009, what every generational wealth creator does during resets. Because when the middle class is forced to sell, the wealthy buy. That's how the system has worked for 300 years. The warning. From September 1929 to March 1931, the first 18 months, most of the destruction was done. Not all of it, but the majority. We are at the modern equivalent of that moment right now. November 2025, September 1929. And the pattern points directly to March 2027, course the 18-month mark, where markets down 60-70%, middle class wiped, retail holdings vaporized, bank failures widespread, wealth transferred. The reset complete. This is not prophecy. This is pattern recognition. The same signals, the same math, the same psychology, the same leverage, the same stage. And math doesn't care about optimism. Math doesn't negotiate. math executes. The choice. You have two options in every collapse. 1. Be forced to sell low, lose savings, lose retirement, lose your future, become part of the transfer. 2. Hold cash and buy at the bottom. Accumulate assets the world is dumping. Turn crisis into opportunity. Become part of the transfer, on the winning side. The next 18 months decide which path you take. Most will choose wrong, not because they're stupid, but because they follow emotions, not patterns. But if you understand the pattern, if you position early, if you stay liquid, calm, rational, the outcome can be different. History does not reward the panicked, it rewards the prepared. The final line, cinematic outro. The clock has started, the pattern is unfolding, the transfer has already begun. The question is no longer, will the crash happen? The question is, when it does, which side of the transfer will you be on?